Good morning and welcome to the VSA Capital 5-Minute Morning Miner on Wednesday, the 23rd of February. And today we've got both Ollie and Paul on holiday. So I'm delighted to say we've got a special guest today. My special guest today is Alison Turner, who is the head of VSA Mining Asset Management. Alison, good morning.
Good morning, Andrew.
What a nice surprise to be able to talk to you on this podcast.
A lovely sunny day for it.
We do quite often touch base on the weather. You're right. Look, there's not a lot of news today, and obviously having you as a special guest, we want to obviously make good use of that value. The one bit of news out today is Rio, who have come out with absolutely record figures and a massive dividend payout. I mean, the market was expecting it anyway, and so the stock is up a few pence, but not a lot. I don't know if you've got any view, particularly on not just necessarily the Rio figures, you may have some, but also on Rio longer term as a stock. Is it one you would hold theoretically? We're not going to discuss what you do hold because that would be a bit too sensitive. But in theory, is it a stock you're positive on?
Well, I think just looking through the numbers, and of course, this is slightly backward looking. We're not looking too far back. The EBITDA numbers are very strong. And I think the thing that really stands out is the free cash flow. They've 17.7 billion in free cash flow, 25.3 billion in cash from operations, but then only spending 7 billion on capex. And that enables them to pay the kind of dividend that they've declared. And clearly, to some extent, shareholders will welcome that. But it's all the way through since 2013, their capex has been below their cash from operations. So they've been generating positive free cash flow, using that to pay down debt and then to reward shareholders. I guess as a mining company, the question is whether that is really a sustainable strategy through the cycle. Historically, what we've seen is mining companies tend to move through periods where capex is higher, and free cash flow is perhaps negative, and they're building up some net debt, and then other periods where it's the opposite. Whereas Rio seems to have for a really quite long period of time now focused on generating positive free cash flow and keeping capex below the level of cash from operations. Just wondering what that means, kind of really longer term. Not just looking out to next year, where production guidance is more or less flat across most of their commodities, but even much beyond that, at what stage does that change? If production's more or less flat, costs go up, maybe commodity prices aren't as strong as they've been this past year. It's hard to sort of see where we go from here. At the same time, valuation metrics don't look massively stretched based on the kind of results we're seeing. So I think it's kind of in that space of here's a stock that's really like throwing out cash and using that cash to reward shareholders. But kind of what's next in a way.
Well, they've used the cash, as you say, to reward shareholders. But I mean, the whole industry has been starved of investment, which is why there's a shortage of new product coming on stream, which is part of the reason why all these commodity prices are obviously being pushed up to record highs, isn't it?
I think that's right. And I mean, historically, the mining sector has been quite strongly criticized for being very pro-cyclical in their investments. So what you'd like to see is them investing at the bottom of the cycle for each commodity. But statistically, what they've done in the past is as the commodity price peaks, they chuck stacks of money into it. Never mind, it takes like 5 years to build a mine, by which time, that particular commodity is not at the peak anymore. And likewise on M&A, buying things at the top of the cycle rather than the bottom. What we've seen in this cycle is much more restrained, where commodity prices, have really, across many cases, seen very high levels. And you haven't seen that kind of capex commitment. You haven't seen that kind of a major M&A. But where does that leave the companies then in terms of growth? And where does that leave the industry in terms of where the new projects come from? And I think you're right, that's across the industry. The other thing I've been looking at today is they've put some figures around their decarbonization spend. And this is one of the things we've been very aware of is what does it actually cost companies to decarbonize? And what does that mean for shareholder returns longer term? Because effectively, you shouldn't expect any return from that investment, right? It's just a pure cost. They've got 7.5 billion earmarked for decarbonisation spend between 2022 and 2030. And they're using an internal carbon pricing to kind of justify or incentivize that spend. I mean, I think my gut feel on that is that's a smaller number than I expected. It's not going to really hit shareholders hard in the pockets. I guess, is that a relief, or does it mean, we're not there yet and it's the next decade we have to worry about? I'm not quite sure.
I love the way you say 7.5 billion is a small number. But there's an interesting point. I mean, maybe we're not top of the cycle yet is one thing. And also, I mean, you're right. But do you feel that M&A from the majors is going to take place? As you say, they've been holding back up till now, but you can't help but feel that the majors actually, what they've got to do is fill up their portfolio of, should we say, young assets that they can grow, and that actually at some stage we are going to break out into a bout of M&A.
Yeah, I think if you look in the gold sector, there's been much more active M&A market. The gold sector's actually seen a lot happening recently, a lot of consolidation, a lot of merger of equals, but also a lot of acquisitions of smaller companies and exploration, or sort of late stage exploration development companies. So it's certainly been happening in that subsector. It's not been happening so much across the base metals and the majors. Arguably, there's not that much out there in terms of the junior space as there once was either. That's also a space that's been starved of funding.
Well, that puts the values up, doesn't it?
Yeah.
Look, I think we will see some M&A, but it may not be quite as wild as in the past, because these guys are being much more cautious because of mistakes in the past. But at the end of the day, we've got to bring on more supply, or else there's just going to be a complete bottleneck in certain commodities. Yeah,
I think that's right. I mean, I think that's a very realistic expectation. And, very possibly companies will leave it. At the moment, shareholders are still saying, great, you're paying me dividends, you're rewarding shareholders, capital constraints, we're loving to see it. You're now starting to see companies like Rio in a net cash position. And perhaps you start to get more pressure from shareholders to say, hey, what are you going to actually do next? What are we doing with all this cash? And so the M&A may come sort of later and perhaps with unduly haste.
I'll tell you what, it is a 5-minute morning miner, but we are going to go on a bit longer. I've definitely got 2 more questions I want to ask you. The first is, you mentioned there about costs going up, and actually I was actually in a mine site on Monday. There aren't many mines in the UK, so most people can work out that it was Tungsten West down outside Plymouth. And one of the things I was discussing was costs, because obviously the cost of energy has gone up dramatically, and that hits mines and various other, the cost of steel and that sort of thing. Now, they felt comfortable that was all going to be offset by the rise in the commodity prices. They're lucky. I mean, they've got tin and tungsten. Tungsten's been pretty strong. Tin has been phenomenally strong. And so they're relaxed. But do you think overall in the mining industry, are you worried at all about rising costs not being offset by the commodity prices at all? Or are you quite happy that the commodity prices have easily offset it?
No, I'm very worried about rising costs. Again, going back to the gold subsector, I think we're seeing it very significantly in that subsector, and really across the board. I think it's being masked by the commodity prices to some extent. But its input cost is labor. The flexibility of labor isn't there that used to be there. Maybe that's still a relatively short-term issue, but people are not able to fly in, fly out like they used to. And that's kind of still, pretty much the case. There's a lot of just friction in terms of getting stuff to where it needs to be. Capital projects as well, not only are they costing more, but key components can easily be delayed. I mean, I think we're very much in that stage of the cycle on the cost front. And I don't think we're seeing it very significantly coming through in the numbers yet, not to the extent that it's kind of really worrying the market. But I think you may see it more next year, where perhaps the commodity prices, having been so strong, are more flat year on year. And so then the focus turns more to, okay, well, let's compare this year's results to last year. Oh, the one thing that's changed is costs.
Yeah, so it's not all rosy in the garden, is it quite? And then look, the final question I've got to ask, where, and without giving away what you're doing in the portfolio, so to speak, or advising on the portfolio, Where do you see excitement in terms of a particular commodity pair? I mean, are you bullish on gold, silver? Do you hate base metals? Do you like some of these critical metals? You know, you and I often talk to you about vanadium. I don't think you've been totally convinced. Lithium obviously has gone ballistic. Is that going to come back? What's your view generally on some of these commodities?
Yeah, we're looking for little pockets of excitement. I think what's happening in uranium is pretty interesting. It's sort of been a story that people have kind of talked a bit, but everyone's always a bit worried about, but the West is actually, getting rid of nuclear. And I think that's changed pretty dramatically over the past year, with the French announcements, for example, quite a significant shift in the longer term demand, and the supply hasn't come to the table as yet. There are quite a few people with projects on the cards, but nothing's really coming, and Cameco's treading very, very carefully in terms of bringing supply back online. So we're excited about that. I think that, as you say, kind of silver, and there's some other pockets of value. Reasonably cautious on where base metals are, not necessarily with immediate term, but just looking at where they have been historically and what that means for returns in those sectors. Margins are very high, and the prices are well above the incentive price for new capacity. So historically, that's a signal to tread with a bit more caution.
Okay, one final question, then I'll let you go. But two commodities that have gone absolutely ballistic in the last 12 months are lithium and tin. Lithium at sort of 65,000, which is just extraordinary. Tin at 44,000. Can they go? I mean, I personally think lithium, we have VSA Capital as the investment bank, a long-term price, I think, of about 14,000 against 65. I mean, can it go higher, or is it just a short-term squeeze? And tin, actually, I'm hearing some people saying it could go to 250,000. Because the amount of tin used in an iPhone is so small, no one really cares, and there's a complete crunch in supply. What about those two commodities? Just give me a quick view on both.
Well, I think I'll talk more about lithium than tin because I know the market, better. But certainly in terms of whether there's any elasticity on the demand side, you would expect yes. As it is, electric vehicles, which is the key, driver there, are not cheap, and they struggle to compete with conventional cars. So you can't afford the price to move to the kind of levels it is and stay there, and not think that that's going to have an impact on how people start to think about demand. But I mean, that obviously doesn't impact overnight. So there it sits. On the supply side as well, your 14,000, 15,000, something like that is not an unreasonable price, because fundamentally, lithium, in the form of spodumene, is not particularly rare. But it's just a question of, how long does it take to get a project ramping up, get it out the ground, and is the conversion capacity there? So, how long that takes to return from stratospheric levels down to a more sensible long-term price is anyone's guess in a way. But that's certainly the direction that we would expect to see it move.
And so you're going to skip on my tin question.
Yeah, I'm going to skip on your tin question.
I'll give you my answer. I think it will go higher short term. I think the real key to tin is that I don't see it ever really going back below 25,000. And if it doesn't go back below that, most of these tin mines make a phenomenal amount of money, particularly the tin mines down in Cornwall, which is of particular interest to me. But on that note, Alison, look, thanks for coming on. It's fascinating. If anybody listening to this has any other questions, I'm sure that Alison will be happy to try and answer them. But it was great to have a special guest on this morning. Thank you, Alison.
Absolute pleasure.